Hello, this is Eric Parnell, Chief Market Strategist for Great Value Advisor Group, and I'm here today to talk to you about emerging markets. And you might say, why emerging markets? With everything that's going on in the US market right now, why would I want to even think about emerging markets? And the reason we're going to talk about emerging markets today is because it provides an important lesson about how we should approach our US investment strategy going forward. Now, emerging markets kind of get a knock. Haven't they always been emerging? Well, the reality of it is that the performance of emerging market stocks has really been challenged over the last 15 years. If we go back to the beginning of 2008 through the present, they're actually lower on a price basis versus where they were 15 years ago. And that's a long time to see the value of your principal go down. But it's important to break apart the emerging market index to understand why it's performed as poorly as it has over this 15-year time period. One of the things that we see when we break down the index is that we see that China makes a disproportionately large percentage of the index. If you go back to July 2020, for example, China made up more than 40% of the MSCI Emerging Market Free Index. That is a very large percentage of your portfolio in a single country as part of the stock market index. But it's worthwhile to look under the surface to see what really has made up that performance. Yes, this China stock market has struggled for a long time, but there are a number of markets in the emerging space that have done very well. Take a look at India, for example. This is a market that's nearly tripled over that 15-year time period going all the way back to 2008. We can also take a look at Taiwan and Korea that have generated strong gains over the last 15 to 16 years since 2008. So even though this big percentage of the emerging market index has performed poorly, that doesn't mean that we need to throw out emerging markets altogether. It's the benefits of active management, taking the time to dig under the surface to find upside opportunities in an area of the market that might not be performing well. Does this really matter for us for those investors that are focused in the US? Yes, because it provides an important lesson. If we take a look at the S&P 500 index, we see that nearly 30% is made up of the technology sector, with significant weightings also in consumer discretionary and communication services. These areas of the market have done tremendously well since the October 2022 lows. But it's important to note, there's been 3 other times in stock market history where we've had a single sector make up more than 20% of the S&P 500. We have the energy sector back in the 1980s, we had the technology sector in the late 1990s, and then we had the financial sector in the mid-2000s. For any of you that are stock market historians, you'll understand that those were pretty dubious times, not only for those sectors, but also for the stock market in general in the years that followed. So as an investor focused on US stocks, don't forget the lessons that we can learn from other markets, including those outside of the US. Just because you're taking a passive approach and owning an index doesn't mean that you're neutralizing risk. For just as we learn from emerging markets, you may be taking on future downside risk that you're not even aware of, even though you own the index. Thanks for joining us for this latest market insight, and I look forward to seeing you again soon.